Hey, good morning, everyone. Welcome to this FOMC preview. We are Wednesday, January the 28th, recording this in the morning. Okay, so first of all, guys, let's just have a quick look and see what the market expectations are. So let's go to the FedWatch tool at the CME, and we could see that for today's meeting, let's just put it here. You can see that for today's meeting, basically 97% of sort of market participants in terms of the Fed Fund futures expect no change. So the basic expectation here is for no change. Only 2.8% of expectations of one 25 basis point cut, so not at all. If we just look a little bit how that has changed, we can see that over the last sort of days, weeks, sort of month, that a sort of hawkishness, so to speak, well, sort of a hold has increased a little bit. So basically, no one's expecting anything much today. If we go out to the next meeting, really what today's going to be all about is, if Powell gives a sense that they're on an extended pause or whether they're just sort of going to be data dependent. Now, you see that for the next meeting in March, the 2% possibility of a cut actually rises to 17%. So still on hold. If we go out to late April, things starting to get a little bit interesting. A bit more interesting. There's even a tiny percent of market participants thinking of two cuts. Then at that point, a few more people thinking of a cut, but still nothing much. And really, you have to go go all the way out to June, where suddenly you're thinking about one more potential sort of cut, or one cut is actually going to be priced in. Now, in terms of the end of the year stuff, let's just have a look at a couple of things here. So, if we look at the probabilities, as I say, the full cut in terms from a probabilistic point of view is not priced in until the June meeting. And then to get two cuts, I mean, do we actually get two cuts? If we go, let's say, by what's the situation by the December, you can see here that the market is fairly evenly matched, but it's sort of a slight majority, so to speak, from a probability distribution for two cuts. So what the market is basically saying is two cuts this year, and we can see that if, for example, we look at the SOFR. What the SOFR market, which is the 3-month short-term sort of bills, is telling us, you can see here that the market at this point is pricing in, one cut, 25 basis points for June, as we just saw. The other one we're looking at was Fed funds, and then another one in October. But what's kind of interesting is that, let's say, for example, and this is where the market could change a lot in the next, few weeks, is that if Trump, for example, does nominate the Rick Reeder, who's on record as saying that he wants to be a bit more dovish and wants to cut more aggressively and wants to have a bit more for pro-growth. I just want you to look here just how all of the SOFR pricings could change. So let's say, for example, we add in another cut. So in September, you see up the top here, I'm going to put, just look here, I've added another cut, and I'm going to sort of calculate. You can see how the expectations change. You can see how everything changes. So what you can suddenly see here is that if we do put in another cut, so that'll be 3 cuts for the year, suddenly the differentials go up quite a lot, especially for the September and December contracts. You can see suddenly the market here. You see how this is repricing here for the September 25 basis points, which is 50 ticks, or for December 2026, 31 basis points. So that's going to be quite key. Now, are we expecting that? I'm going to reset the defaults. Are we expecting that today? No, because we don't know who the new Fed chair is, but we do know that Trump wants someone more sort of dovish. So you can just see that would be sort of a great trade. Now, the other thing to keep in mind is that the market has repriced quite a lot over the last few weeks. So here I've just got the general sort of a curve of all the bonds. And you see here going out from the 2-year all the way out to the ultra bond, which is sort of like the 30-year. Now we know that the Federal Reserve, they have most effect on the front end of the curve. So if we look at, let's say, if we compare this to, for example, 1 month ago, or 2 months ago, we'll just see how the curve has changed. And so what we can see is that the current one, which is this blue line, this is where we're here all up the curve. But you can see also at the front of the curve, I mean, all across the curve, but at the very front end, let's say the 2-year, you can see that, 1 month ago and 2 months ago, there's been quite a lot of difference in the sense that all of the yields have moved upwards. So all across the curve, especially, let's say, from the 3s to 5s, but at the front end, or basically all the way out to almost all the way out from 2 months ago. The curve has moved up quite significantly, and we can see that if we look at a few different charts. So let's say, for example, we're looking at the SOFR. Now, what I've got here again, just to look at what the markets, how the market has changed. So let's say, for example, looking at the March contract. So this is the March SOFR contract, and you can see here this is basically the change which the market is expecting. So if we go back to, let's call it the 1st of December, which is here, and this is where we are now. So what you can see is that on the 1st of December, the market was expecting, by this sort of March, April period, about 57. See that negative? This is how many cuts. So negative 50 to 60 basis points. And you can see now that we've moved all of that off, and we're now at zero, only 2. So you see here this huge repricing in a sort of a hawkish way. So the other thing, let's say, for example, go to the end of the year, let's say by maybe not the end of the year, let's go for September. So slightly different, but it's a similar kind of situation. So the market again has moved. Now, the market at the moment for later in the year, so that's September, October period now, is expecting maybe 35 basis points, so 1.5 cuts by that period. But again, you can see that if we compare it to, for example, the 1st of December, you can see again that the market has actually repriced 70 basis points of more hawkishness. So keep in mind that a couple of months ago, the market was pricing in 4 cuts. So that's a -1%, so 4 times 25 basis points. The point I'm trying to make here is that even though Powell today may signal a sort of a hold and may signal that there's no need to cut, that's not at all going to be a surprise to the market, because the market in essence has done the work over the last let's say last 2 or even like 3 months, if you look here, and it essentially has taken those cuts out of the pricing. So that would not be a surprise at all. Now, another way of looking at that, for example, is if we look at a couple of yields. So let's say, we'll look at, let's say, the 1-year yield. So this is the 1-year yield. Now, that hasn't changed too much, but even there you see that it's gone up a little bit. But really, if we look at something like the 2-year, you can see in this period here, again, let's say, for example, just going back to, even just around Christmas time or so, or again, sort of December period, you can see that the yield, which was down at about 3.45 or so, has reached a peak of about 3.62. So even looking 2 years down the track, the market has repriced fairly substantially in a sort of a more hawkish way. Now, obviously, at the end of the yield curve, the long end, if we go out to the 10s, you can see that that's pushed higher, and you can see that the 30-year yield, which is here, you can see that's pushed much higher. Excuse me. So what's that's telling us, that's giving us steepness. So long end yields are going up much more than front end yields. And essentially, what is that telling us? That's the market basically telling us that the Fed will not hike, but the Fed will not cut too much at all. So the front end yields are relatively stable. And again, let's just, as I'm talking, look at the 2-year. And it's almost saying, hey, the yields on the front end will probably not go up too much more than, let's say, 3.63, 3.64, 3.65, because we know that there is still some downside risk potentially to the labor market. And more importantly, perhaps, is that the new Fed chair coming in June, he or she, probably Rick Rieder, potentially will definitely want to be cutting a little bit more. So that's why the front end of the curve is relatively anchored. But on the other hand, we still have relatively sticky inflation, although it's not crazy. And we still have relatively good growth, although not explosive. And we still have a relatively good employment situation and labor market. So therefore, the growth indicators, which is essentially, the 5, 7, 10, 30-year, the belly and further out on the curve, those yields are going up a little bit more, just to express the fact that there's still a lack of sort of fiscal discipline. The government's still spending plenty of money, issuing plenty of long-term bonds. The real economy is still doing quite well. The employment situation is doing quite well. And it could also be that in terms of fighting inflation, the new Fed chair will be a little less aggressive than he or she needs to be in theory, and that will have some slightly upward pressure on inflationary on inflation and therefore the yields. So overall, what the market is telling us is a few things. Just to summarize, it's saying the Fed will cut somewhat, once or twice. Now, maybe the new Fed chair will cut more, and that's where there could be a trading opportunity. The market has told us that not anymore. It's not going to cut any more than that because it's repriced over the last 2 months to 10 weeks or so. Thirdly, the market is telling us that the front end is relatively anchored. It doesn't need to change that much. It's quite comfortable where it is now. But it's also telling us that because of, relatively strong employment situation, real economy, inflationary, relatively sticky inflation pressures, the back end of the curve needs to kind of go up a little bit. So we're getting a sort of a gentle steepening, more or less structurally. Of course, there are days, it may be in a week or two here, where we get a flattening depending on news flow and whatnot. So that's really what that's where we're at. Now, in terms of the economic data, what we need to look out for today well, we'll get onto that in a second. So what I want to look at as well as in terms of market expectations is also, well, okay, what kind of move can we get today? So let's consider the equities. What is the volatility market pricing in? And I just want to have a bit of perspective here. So let's look at, I'm just going to use the straddle, so 1 day or kind of like a 0 DTE straddle. So, long the at the money call, long the at the money put. So how much volatility and movement is the market expecting today? Now, keep in mind today that we don't get any SEP. We don't get an update to the summary of economic projections telling us where the Fed thinks the economy and inflation will be going. So, that's we're not going to get that. But it's interesting if you look at the SPX, DTE days to expiry, ATM straddle cost, and FOMC days, you can see that overall, and this is percentage on the left-hand side, you can see that we got a huge amount of volatility and expectations of volatility going back into, 2022 was really the point where we had very high inflation. But you can see that overall, that sort of the cost of the ATM straddle is actually coming down. And if we look, the last one is just over about, 50 to 60 basis points. So you can see that it's going down overall. So the market is becoming less and less convinced that these FOMC meetings will cause a lot of volatility. So, another way of looking at is to say, well, okay, what has typically been the SPX change on FOMC day? Now, again, this is 1:59. This analytic is looking at 1:59 p.m. So just before the 2 p.m. Release of the data up until the close. So essentially what we're trying to say here is, hey, just basically before 2 p.m. until the end of day, how's this gone since, going back about 10 years or so? And you can see that overall, we've had some big numbers on the downside, but overall, not a huge amount. We're talking again, 50 basis points, 60 basis points. There was an outlier about a year ago, but overall, the last, let's call it kind of year, we're really talking less, around about plus to minus 50 basis points, which is not a huge amount. Now, in terms of just the straddles, also just to keep in mind that, of course, when you're buying a straddle, you're long gamma, you're paying up for implied volatility. And of course, normally, which is typical for a lot of sort of market events like economic data or let's say FOMC days, CPI, these kind of things, you do get some theta decay. You do get some sort of decay. You get a pretty vicious time decay, theta decay, but also just the implied volatility kind of crushes. So you get this vol crush. And you can see here, again, going back about 10 years, just the at the money straddle decay, you can see here on a time basis. So you can see here that you've got the previous close from 24 hours ago, the regular trading hours open, London close, sort of mid-morning, whatever, 1 p.m. And then from 2 p.m. Now, 2 p.m., of course, is when the statement comes out, and sometimes a summary of economic projections. And just quite fascinating to look and just see how, in general, the at the money straddle, it really decays. The implied volatility crushes down, reduces significantly, and that rapidly loses value, especially, if you're starting off with sort of higher percentage values, obviously that decays more quickly. So you see between 2 and 3 p.m., there is this, pretty significant sort of fall off in sort of the value of implied vol and the value of those straddles. So getting on to what we've got today, just keeping on this sort of idea of what represents good value. I just want to go here and look at, actually, before we look at that, I just want to go into so you see here, for example, so for the ES or even the SPY, you can see for the ES futures here, you can see that the 52-week implied volatility ranking is just in the 20 out of 100. So pretty much on the low side. The VIX is relatively low at the moment, no heightened expectations. If you actually look at the implied volatility percentile, so this is in percentiles, 0 to 100, going back 1 year, 52 weeks, you can see we're only 14. So that's very low. So, basically, what we would expect. So let's look at the straddle, and I've got here, let's have a look here. Let me actually just clear that. So I'm going to just put on the straddles for you see the S&P now trading at about 7,016 on the futures. But if we put, so we're going to put here the straddle here. So we've got the 50 delta. So we're going to go long that one, and we'll go long the 49 delta. So again, you see the straddle here at the money. So 49 delta on the put, which is going to cost 15 points or 60 ticks, and going long is going to cost 16. So what we've got here is basically a 30-point straddle. Again, you see the at the money so implied vol is 21% just on the daily, so not very much. But if you look here, it's going to basically cost 30 points, which is assuming about 120 ticks. So the market is telling us that a move plus 30 points or minus 30 points, about 120 ticks, is sort of what the market is expecting or pricing in. So anything more than that would be a bit of a surprise. So if we just look in percentage terms, let me just do the math here. So 30 divided by, what is it? 7013 times 100. So just doing the maths here. So we're getting about a 43 basis point move. So what the market is pricing in terms of the option markets on the S&P 500 futures is, about a 43 basis point move either way. Which, as we can see, is relatively low. So all that to say that the market is expecting, a fairly docile kind of meeting. And what does that mean? What's expected? We're expected for for Chair Powell, and basically to emphasize, that the FOMC has already cut 3 times. Basically, the labor market has been stabilized by that, and it's well positioned. So that's going to be the fairly boring sort of comment, which Powell will talk about. He's going to say, "Hey, we've cut. We're going to be data dependent. We need more information. No need to hike. No need to cut." Also probably we're going to see increasing consensus within the FOMC committee. We're seeing that, the doves have had some cuts, so they should be happy. The hawks are probably saying, hey, we don't really need to sort of cut, sort of to hike in any sense. So probably there's going to be a bit more consensus. So not really expecting too much more. I mean, what could surprise? What could surprise would be if Chair Powell talks about his own plans. Is he going to stay on as a member of the Fed as a governor? Probably he's not going to talk about that. He's probably going to not talk about Lisa Cook. He's probably not going to talk about Trump. He's probably not going to talk about who could potentially be the new Fed chair. Powell, he's going to keep it very, he's not going to say too much. Where it could get interesting is maybe in the statement, maybe dissenters. So let's just have a look at the statement. Now, keep in mind, there's no summary of economic projections. But if we have a look at the statement, first of all, what could be kind of interesting is dissenters, people who vote against the decision. Now, that'll be obviously at the end of the statement. Now, presumably, and typically, probably Stephen Miran, who was Trump's representative and appointee, very, very dovish, he may vote for a 25 basis point cut, or even a 50 basis point cut. That's not really going to excite the market too much. What would be interesting would be, for example, a second dissenter, for example, Chris Waller, maybe voting for a cut. That would be interesting, because if we do get one dissenter, Miran, that's expected. But if we've got a second dissenter voting for a cut, that could negate any sort of hawkishness in Powell's press conference, or perhaps even in the statement itself. Because really what we're trying to figure out here in the press conference, and even in the statement, but let's say in Powell's comments, is this a sort of, are we on an extended pause? Are they saying, like, listen, we're not cutting for many, many, many months? Or is it simply, hey, we're going to be data dependent and we're going to remain nimble? That's really what the market wants to know. And we might get some clues for that. Probably one of the most interesting things will just be in the first paragraph or two of the statement. This is the last statement here. We just want to see what it says about economic activity. Has been expanding at a moderate pace. Do they change the language there? So keep an eye out at 2 p.m. today for a change in that statement language. Do they say has been expanding at an increasing pace, or just going to say moderate? And then also job gains have slowed this year. And the unemployment rate has edged up through September. What are they going to say about the employment data? If you look at initial jobless claims, they're very, very solid. And it could be that in this first paragraph of the statement, the Federal Reserve, the Fed, will basically say, hey, unemployment situation is pretty good, because, and they say the unemployment rate has edged down, and job gains have remained consistent, or something like that. And then, of course, another big one is going to be inflation. What do they say about inflation? So remember, last time they said inflation has moved up, and remains somewhat elevated. Again, are they going to change the wording? Are they going to say that it remains elevated, or will they say that it's stabilized? So that's really going to be quite key here. And if the statement changes to reflect a better employment situation, strong growth, and a moderating inflation, you have to say that that's at the margin a little bit hawkish. And if there are no dissenters apart from Iran, that could indicate that the Fed really has no intention of cutting over the next 2 or 3 meetings, which, by the way, is what the market is saying. Remember, going back to the beginning of the video, we saw the market is essentially saying one cut around about the middle of the year, June, July, and sort of another cut maybe around the end of the year. So really, what would be a surprise would be if Powell comes out and says, "Oh, we're not cutting for 6 or 8 months." But again, he's a lame duck at this point in the sense that he's leaving. So does the market really care? So all in all, not expecting a huge amount of sort of fireworks today. Again, is he going to comment about the dollar? Probably not, because the Fed in general, the Federal Reserve in general, Powell is on record as saying, "Oh, that's the affairs of the U.S. Treasury. That's not really the Fed. The Fed reacts to stuff," but he's probably not going to talk about the exchange rate. But it was interesting, for example, in contrast to ECB members who we saw in the last 24 hours, starting to mention a little bit that the increasing strength in the euro, for example, could affect sort of monetary policy decisions if inflation expectations change. That's not really the vibe which the Fed likes to give out, but it could be interesting. He may be asked about the dollar. We'll see if Powell has anything to say. So in terms of market reactions, as I said, the front end of the curve is fairly stable at this point. Is he going to talk about sort of bills issuance or this kind of thing? It's possible, but I don't really expect too much at this point. I don't expect him to be particularly political. That's not Powell's style. If he's sort of hawkish and the statement is hawkish, could that give a short-term boost to the US dollar? Yes. But we know all the structural factors which are going to weaken the US dollar. So it could be a short-term boost. That could even be a sell the rally kind of situation. If it remains fairly benign and basically says, "Oh, inflation is sort of not too bad, a bit sticky, but we're okay with it. Unemployment is good in the sense that the employment market is good, and the growth, it looks pretty good." That could be a boost for equities. Why not? If you have a Fed which is cutting once, if not twice, if not thrice, that could be a boost for equities. So I think really what the market wants, the equity market just wants sort of a nothing burger in a sense, and that will give it the green light to keep on pushing higher. We're seeing it's pushing higher this morning on the back of some good tech earnings. And of course, we have all the big tech earnings after 4 p.m. this evening. Okay, guys, so I'm going to leave it there. I hope that was useful. Have a good afternoon. And obviously all that stuff's happening at 2 o'clock for the statement. And then Powell himself will be speaking at 2:30 as normal. Thanks very much. Have a great afternoon.